Good morning and welcome to today's webinar. By way of introduction, my name is Anindya Ghosh Chaudhary and I'm a director in Forbes Mazars' dedicated banking risk consulting team. Joining me today is Freddie Blake. Freddie, would you like to quickly introduce yourself?
Hi everyone. So as India said, my name's Freddie. So I work with India as an associate director here at Forbes Mazars. In a previous life, I worked at the Bank of England, where I spent quite a bit of time on the capital assessment team, looking at the capital requirements of non-systemic firms. So the small deposit takers regime is particularly close to my heart.
Perfect. Thank you, Freddie, for the introduction. So, as you know, today we'll be talking about the small deposit takers regime, which is widely known as SDDT. And this is at the back of the publication of CP 724 from about a week ago. Now, today's focus will be on SDDT's capital proposals that are aimed at non-systemic firms. And as you know, this comes into effect on the 1st of Jan 2027. We are on LinkedIn Live today, and this session is being recorded. But let that not, interrupt your questions that can come in through the chat on Zoom, and indeed through LinkedIn comments. And we'll try our best to get to them in the end. But if not, we'll get back to you separately on those questions. So today, we'll focus on capital expectations that were introduced by CP 724, and indeed the consequent changes to the disclosure and reporting requirements. However, before that, it's worth noting a couple of things on liquidity expectations. Now, guidance on this was communicated by the PRA last December. And as you know, that these rules have already come into effect on the 1st of July from this year. And as a result, we're not going to spend too much time on it during this webinar. However, it is worth noting briefly that, because of the CP 724's provisions, it introduces a significant update to their liquidity proposals. And that update is that firms will only be required to complete their ILAP on a 2-yearly basis as opposed to an annual basis going forward. So that is already a big positive for firms that fall within the SDDT criteria. And similarly on the SDDT criteria, we won't spend too much time on it other than providing some market intelligence on that subject. So it is my expectation that at the end of this webinar, you'd be walking away with an understanding of the major capital proposals that stem from the recent publication, the major implications that it has on your regulatory reporting arrangements, and indeed how it would impact you and some of the assumptions that you might need to make, as we approach the date of implementation. Now, before we get stuck into the capital rules, I would like to briefly cover the SDDT criteria because we have had some very interesting market insight on this topic, which suggests that the PRA are more flexible than previously indicated. So, Freddie, would you be able to say what information you have on this topic?
Yeah, no problem at all. And thank you for your introduction in India. So, as most of you are going to be aware, in order to be eligible for the SDDT regime, a firm's going to need to basically meet 7 different criteria. And so this includes, for example, needing to have at least 85% of credit exposures to the UK, or not having a trading book larger than 5% of the total assets, or £44 million. So in the most recent CP 724, based on these criteria, the Bank of England's current estimate is that about 80 firms will fall under the definition of SDDT. However, so we've had some discussions with firms that suggest that the criteria for defining an SDDT isn't as strict as it would first appear. So over the past 6, 9, 12 months, we've had conversations with a few different firms who may be in breach of one of the criteria associated with the SDDT regime, but they've been invited by their supervision team to apply anyway. And I think this seems to be particularly true of firms that are bumping up against the limited trading activity and also domestic activity thresholds. So, as a result, if you're working at a firm that's on the threshold of 1 or even 2 SDDT criteria, it might be worth discussing potential eligibility with your supervision team. You'll never know what you might find out there. And just one final area of the SDDT criteria that I think it's worth highlighting is related to the specific definition of the limited trading activity requirement. So there have been questions in the industry about whether the proposed limit to the trading activity would include swaps for hedging purposes. And so we took liberty to have a conversation directly with the regulator about this particular topic. And their response was to highlight the distinction between, your trading book and your banking book. So to give an example, when you're using hedging to mitigate things, say like interest rate risk, that could fall under the firm's accounting trading book rather than the regulatory trading book. And that would allow more firms to meet the requirement. Now, that sounds a lot like sort of regulatory speak. So to summarize it really simplistically, basically hedging instruments, they are allowed. They're not going to count towards that trading book threshold. And that should, I imagine, be good news for a number of firms that may be on the call today.
Indeed, and thank you, Freddie. And I think that making that distinction between the accounting trading book and the regulatory trading book is a very important one when it comes to firms looking at their, derivatives and considering whether that might enable them to be a part of the SDDT. So thank you for that. Now let's go into the section that I believe everyone is here for and discuss the recently released publication. So what are the main aspects of the capital proposals, Freddie, that you'd like to call out today?
So there's quite a lot changing under proposals. So what I'm going to do is I'm proposing to just work through the capital stack, covering first pillar 1, then pillar 2A, and then pillar 2B, and then address, the main substance of what's being altered in turn. So if we start with pillar 1, firstly, under the current proposals being set out in that CP 724, there's going to be broad alignment, in particular between two elements of the SDDT framework and the rest of the capital framework, the sort of Basel 3.1 capital framework, as it will be in the near future. And that's namely the fact that under the current proposals, there's going to be a broad alignment between, credit risk and operational risk in particular. So this is going to include application of Basel 3.1 risk weights for SDDT firms, and it's also going to include application of the revised standardized approach for operational risk for SDDT firms. So that's going to mean that firms, SDDT firms, they're still going to need to carry out that gap analysis of their risk-weighted assets to understand what that change is between the current CRR and those future Basel 3.1 standards. Now, that's what's sort of being aligned between the SDDT Pillar 1 regime and the wider capital regime. In terms of what's changing, there are a few areas where the Pillar 1 proposals do diverge from the wider capital regime. So in particular, under SDDT, you're no longer going to need to review market risk FX, CVA, or credit concentration risk in your Pillar 1 as part of your ICAP assessment. But to be honest, I don't actually think that's going to make a huge amount of difference to most SDDT eligible firms. And that's mainly because, a lot of these firms don't carry these risks anyway. They're not going to be analyzing them in their Pillar 1, in their ICAP. So it's not really going to move the dial that much.
Thank you, Freddie, for summarizing that. And, the changes to Pillar 1, as you perhaps pointed out, and correct me if I'm wrong, it doesn't seem that it's too exciting. But when we get to Pillar 2A, it's a different story. Is that what your understanding is as well?
Yeah, I think that's fair enough. I think that for Pillar 1, the Basel 3.1 approach is where the real interest lies in that credit risk, and there's not much divergence there with the SDDT approach. But in Pillar 2A, that's quite different. So here, the main headline is, I guess, simplification is taking place across the board. So you've got simplification of, in particular, the Pillar 2A credit risk, credit concentration risk, and operational risk approaches. And then you've also got disapplication of the market risk and group risk assessment for most SDDT firms. So what I'm going to do is I'll spend a little bit more time covering credit risk, credit concentration risk, and operational risk in particular, because I think those are the areas that will be of most interest. So if we start with credit risk, what we're seeing here is the PRA essentially proposing a shift away from what is currently the main focus, which is around that kind of IRB benchmarking approach, and towards, in some instances, actually a greater focus on stress testing in the Pillar 2A section of the ICAP for credit risk, in particular for firms that are either new or engaged in higher risk lending. So at the moment, the PRA actually does expect that firms, as part of their Pillar 2A credit risk assessment, they conduct that short, sharp 12-month stress test. But this guidance is actually, it's often actually ignored by firms and also sometimes by the regulator as well. And that's mainly because, at the end of the day, the stress testing analysis, it's more complicated than IRB benchmarking. And also because the regulator often doesn't seem to pick up on the fact that it's missing from firms' ICAPs. So what this will actually mean is that there are going to be some SDDT firms out there who don't currently conduct this analysis, but they're going to actually need to develop that area of their ICAP document going forward. And on this particular topic, I think, supervisory guidance around the credit scenarios and how they might specifically impact those Pillar 2A credit risk requirements, that will probably be really welcomed by firms. It's not something that's really covered in the current guidance published by the PRA, but unfortunately, it doesn't really appear to be provided in the annexes accompanying CP27 in terms of setting out a bit more detail there. So I think that's something that firms might consider as part of feedback in the consultation period.
Yeah, you're quite right. So that is certainly an area that's something to consider, in early December, I suspect, prior to that, in fact. So what about credit concentration risk? So the HHI methodology is getting scrapped. Is that correct?
Yeah, that's right. And I'm sure when, a number of people on the call read this, their fists were being punched into the air across the United Kingdom, because it's certainly been a long time coming. But essentially, the new approach is really just going to consist of a simple add-on. They're going to be components for retail and wholesale exposures. But the one caveat is there may be some further overlays for single name and sector concentration risk and these will be assessed essentially on a firm by firm basis. So just quickly how that's going to work. For single name concentration, the regulatory review is going to be aligned with the large exposure limit. So basically, it's additional scrutiny. It's going to be given in instances when a firm has a totality of large exposures above 300% of their tier one capital. And likewise for sector concentration risk, if you're a firm and you have significant wholesale exposures, you're going to need to clearly incorporate this as part of your Pillar 2B stress scenario analysis. And if you fail to do that, that might result in a capital add-on.
Absolutely. And again, there's the use of the word significant in a number of instances. So I think the PRA has left it for firms to determine what might be significant for them, and they might need to convince the PRA of those thresholds when they meet with them as well. Now, moving on to operational risk, Freddie, this was always one of the most unclear aspects of Pillar 2A. Most people didn't really have an idea, how the PRA actually calculated the capital add-on. So I suspect it's good to see that it's heading for a change.
Yeah, and here, firms are going to be placed in one of three different risk buckets based on their existing operational risk capital requirements, but also based on that concept of PRA judgment. So here, the capital requirement is going to be a percentage of total assets, with that percentage figure aligned to the risk bucket that a firm is assigned. And so whilst I do think, the change in calculation is going to be welcomed by firms, because at the moment, the current regime is essentially pretty much a black box. There isn't, for example, that much detail in the guidance around how firms are going to actually be assigned into the different operational risk buckets on an ongoing basis. You've got that infamous phrase, supervisory judgment, that's sprinkled quite liberally in the CP, especially in this section of the CP. And certainly that guidance could be clarified further by the regulator. And then, of course, you've also got this idea of, the operational risk scenario analysis that you currently have to do in your ICAP. That's still going to need to be performed. So from a drafting perspective, I don't think a huge amount is going to change for operational risk under SDDT for Pillar 2A of the ICAP.
Thanks, Freddie. And what about the capital impact of these changes? Is it going to have a big impact on firms?
Probably not as much as you might think. And that kind of has been the intention of the PRA from the outset. They want to simplify the capital regime, but they don't want to reduce loss absorbing capacity. That isn't to say that there aren't some winners and losers. So if you take firms on the refined approach, which is getting removed as an example, and that refined approach, just to quickly recap, that basically is, if you're at the moment clearly overcapitalized for your Pillar 1 credit risk, which you can identify via IRB benchmarking analysis, you can get a capital offset in your Pillar 2A add-on. And this is particularly applied for low-risk building societies and banks. They're most commonly on the refined approach. Now that refined approach is getting removed, there's a strong possibility that those types of firms, their capital requirements may actually increase.
That's very interesting, Freddie. Thank you. So that's a lot about Pillar 2A. Now let's move on to Pillar 2B and what seems to be an equally big news story here, introducing one buffer for SDDT firms and getting rid of the countercyclical combined and PRA buffer in the process. What's your take on that?
Yeah, I mean, I think this is the big proposal stemming from CP 724, and that's obviously the introduction of that single capital buffer that's going to replace the current buffers framework, and it's going to be set basically at a minimum of 3.5% of RWAs. The buffer is going to be informed by three components. So I'm just going to quickly break down what those are. So firstly, you've got the stressed impact component. And that's actually very similar to how current stress analysis that you'd be doing in an ICAP essentially informs whether you need a PRA buffer over and above your countercyclical and combined buffers. So the focus of this component is going to be on understanding CET1 capital depletion during stress scenarios. So it's kind of reinforcing the significance of stress testing. And it's also highlighting the fact that stress testing analysis is going to be the most important determinant of the size of a firm's single capital buffer under the new regime. So that's the first component. The second component is aligned to sort of a risk management and governance assessment. Again, this is quite similar to the risk management and governance scalar approach that is included in the current framework, which is normally applied by a supervision team when they think basically a firm has material risk management or governance shortcomings. And it's worth saying that this kind of assessment often focused on issues that might sit outside of the capital risk profile of a firm. And so that's the second component. And then the third component is our favorite phrase, supervisory judgment. It's back again. And this basically seems to be most likely to take place when the PRA doesn't believe that a firm's stress tests are severe enough or plausible enough, a fair reflection of their risk profile. And so in those instances, there might be, an increase to your SCB as a consequence. So those are the three components that inform the new single capital buffer. There are just two other key aspects that I think I just want to highlight because I think they should be considered or noted. And one is around the fact that the use of the SCB during stress, it's not going to compel banks to suspend payments such as dividend payments. And then two as well, the regulator, it's really keen to emphasize the fact that firms, if they're utilizing their SCB in a stress event, it's not going to trigger any PRA, supervisory actions at all.
That's quite a lot going on, Freddie. Thank you for explaining them in detail. Is that good news or bad news overall?
So the Bank of England, they seem pretty convinced that the proposal is going to be a big benefit. And that's because, and this is in their words, not mine, it's going to make the Pillar 2B capital requirement more consistent and also easier to understand. I'm not sure if I would fully agree with that. And there are a couple of reasons why that I'll just quickly explain. So at the moment, the CRD4 buffer regime, that is the combined and countercyclical buffer, it's pretty clear. The buffer requirements, they're standardized, right? They're fixed amounts, meaning they're easy to follow and understand. Whereas the SCB, it's going to be more idiosyncratic, more subjective. Like I said, you're going to be more reliant on that favorite phrase of our supervisory judgment. I'm also unsure if in practice the single buffer is actually going to really reduce incentives for firms to hold additional management buffers for capital. So this idea of buffers on buffers, which the PRA are really keen to try and address in the new proposals. So, in my opinion, there's still going to be a strong focus on ensuring that firms aren't falling into their buffers from the regulator, but also from the firms themselves. Because if you're going into your buffers, you're probably going to need to start spinning up management actions related to stress or even potentially recovery. And that's not something that senior management wants to enact. It can impact your strategy. It can impact your business model. It's a painful process to go through, so it's best avoided. And finally, while use of the SCB during stress is not going to compel banks to suspend things like dividend payments, I can't see, to be honest, in India, there being many circumstances where the regulator is going to allow a firm to just be paying out dividends, bonuses, whatever it may be, whilst it enters capital buffers. That seems like a bit of a stretch to me at this point in time. So overall, there's a lot of noise. There's a big headline change. But really, I'm not sure if the fundamentals, some of them are being altered that much.
And that's a fair point, Freddie, because the COVID crisis was a good example of the PRA flexing their muscles, so to speak, and preventing firms from paying out dividends. So that is a fair point. And is this going to have much of a capital impact? It looks like the 3.5% RWS threshold will reduce a lot of SDDT firms' buffer requirements by about 1%.
Yeah, that's right. I mean, that will be the maximum impact for most firms. And as you say, like a 1% decrease, sorry, is not insubstantial. But ultimately, that's probably going to offset a slight increase actually in your Pillar 2A capital requirements from various different moving parts, such as removal of the refined approach for some firms. So, overall, I think the approach is to try and ensure that these proposals are net neutral. But yeah, I think for a lot of firms, you might be seeing a slight decrease in your requirements under your Pillar 2B. Right. So now I'm going to take the turn of the questioner for the sort of last third of the webinar. And we've just covered the proposals and the extent to which they're going to be having more or less of an impact from a capital perspective and from a ICAP perspective than they first might appear. But I think it would also be useful for us to quickly explore some of the more operational aspects we mentioned earlier in the webinar, and in particular around regulatory reporting. So if I could just start in India with asking you about the frequency at which firms are going to have to actually update that ICAP document or sub-elements of it. Are there many changes there?
So we'll get to the frequency in a bit, but unlike the ICAP guidance, the ILAP guidance that almost stipulates that the structure of the ILAP changes quite a bit, it doesn't look like it's the same story for ICAPs. However, what will be changing is how often SDDT firms will be required to update their ICAP document, which is the question you asked me. Now let's look at the big headlines here. You are still going to have to complete Pillar 2A and Pillar 2B analysis on an annual basis, so that requirement remains. However, the full ICAP document, very much like the ILAP document, will only need to be completed once every 2 years. And the same applies for reverse stress testing. However, these rules will not apply to new banks or indeed firms where the PRA has deemed your ICAP to be of low quality. So this loops back to Freddie, your earlier point that, the quality of the ICAP and the stress testing is of paramount importance as a part of the SDDT rollout. Now, this all looks good, but bear in mind that because Pillar 2A and Pillar 2B analysis is often the most or the more complex aspects of the ICAP for smaller firms, the time efficiencies that you see, at least initially, might be less significant than what it appears to be on the first glance. But the relaxation of the frequency at which the ICAP, the ILAP, and the reverse stress testing should be completed is good news and in a step in the right direction. And that over time will definitely lead to more time efficiencies for firms.
Fantastic. I'm sure that would be good to hear for a number of people on the call. And in terms of the regulatory reporting requirements for our second favorite topic after supervisory judgment, which is regulatory returns, for capital returns, is there going to be much change there? Because there was quite a bit of change in terms of the liquidity returns being descoped, I think ALMM. So is something similar happening in terms of capital?
Good question. So the headline is that the PRA are descoping a number of regulatory returns, and they're also making some targeted amendments. These returns include, core upon funds and some Pillar 2 specific reporting, such as, the FSA 076 and the 079. Now, this sounds like good news. However, there are some caveats. Now, the reduction in operational burden for SDDTs is or may not be as stark as it may first appear, which follows in through the theme that we have been talking about through the webinar. And that's because some of these returns are annual returns, and therefore they're not reported as frequently as some other returns that are being retained as they are. Some returns are indeed being descoped, such as the FSA 072 and the FSA 073 returns on Pillar 2 operational risk. But again, these carry relatively lower operational burden to populate. So again, there's a question on how much time efficiencies one might expect to see at the back of these proposals. And finally, there are some amendments that are a little bit more minor. For instance, the PRA 111 return. There's an introduction of only one row and only minor changes to instructions. So we expect that initially there will be an increased operational burden as firms update their working files and regulatory reporting procedures to comply with the changes that are being brought about by SDDTs. Such updates, as you know, must also ensure that appropriate governance and control processes are set to mitigate the risk of errors. So there will be time input going into implementation in the first instance. Now, the reporting changes, like the capital proposal set out by the PRA, come into effect on the 1st of Jan 2027, which should provide enough time for firms to make these preparations before implementation. So that is essentially what I'm going to say on regulatory reporting. So thank you, Freddie. So that brings us to the end of the webinar, and I'm just going to look at my chat to see if there are any questions that have come in. And indeed, there are two. So we'll try and cover both now. So the first question is, how will the interim capital regime work, Freddie?
Okay, so for the interim capital regime, basically SDDT firms, they're going to be able to utilize that in 2026 to avoid having to implement full Basel standards. And current requirements are going to just still apply as part of that. I think the confusing bit about the current proposals, and actually something I didn't pick up on during the webinar itself, was the fact that the PRA are going to conduct an off-cycle review, and I think that's for specific firm-specific Pillar 2 capital requirements. And it's trying to align with the Basel 3.1 standards, specifically around adjustments relating to the SME discount factor, trying to adjust for the removal of that in Pillar 1. So it's not entirely clear for SDDT firms what this will entail. Will it also include an assessment of, a forward-looking assessment of what their capital requirement may be like under the new SDDT regime? That's not exactly clear in the guidance at the moment, but basically it's going to come into force for the duration of 2026.
Thank you, Freddie. And the second question that I have here is the PRA getting rid of the requirement to conduct operational risk analysis to a 1 in 1,000 confidence interval?
So that is, at the moment, the guidance in the Pillar 2A for operational risk, isn't it? I don't think so, actually. I went into some of the appendices and the draft alternative supervisory statement for SDDT. I think that the number of operational risk scenarios is being reduced, and there was talk of maybe 2 or 3 instead of 4 or 5, which is more common. But I don't think the 1 in 1,000 year interval is being changed by the regulator.
Yes, I think I'm inclined to agree with you on that, Freddie. Okay, so there's only 1 minute to go. So let me use that minute to thank you.
I've just spotted there's one more question in the chat, which is around this. Is this a simplified buffer?
Oh, yes, go on.
Isn't this simplified buffer just 3 buffers in one? Very quickly on that. Yes and no. So yes, because there's that minimum amount of 3.5% RWAs, which basically is trying to set in a backstop for the quantum of capital that you have to hold that is aligned with the current CRD4 buffer approach. But no, because I think the new single capital buffer is more idiosyncratic and more dependent on your stress testing analysis in your Pillar 2B. Whereas at the moment, only the PRA buffer is really the component of the Pillar 2B framework that takes that into account. So yes and no to that.
Thank you, Freddie. And thank you for your insights, and thank you to everyone who has joined us today.